Hi, I'm Bill Spaulding. Welcome to WCS Money Tutorials. You can make a lot of money from leveraged exchange-traded funds. For instance, by investing $100,000 in TQQQ in March 2020, when stocks reached their lowest level at the start of the COVID-19 pandemic, you would have almost $1 million a year and a half later. The stock market did pretty well too, but not nearly as well. For instance, the SQQQ ETF is based on the top 100 companies in the NASDAQ index. ProShares UltraPro TQQ is also based on the NASDAQ 100 index, but it has triple leverage. But as you can see from these graphs, the leveraged fund actually did much better than 3 times the unleveraged fund. But leveraged funds also have substantial risks, so this video will explain how you could profit using these funds and how to minimize the risks. Leveraged securities are designed to yield an investment return 2 or 3 times that of the underlying securities or index. Leveraged securities are based on major stock indexes, major sectors of stocks, bonds, and even interest rates. Long securities increase when the underlying securities increase in price. There are also inverse securities, both leveraged and unleveraged, that increase in value when the underlying securities or index declines. Leverage is usually accomplished using derivatives, such as futures and swaps. Long funds also buy securities underlying the investment objective of the fund. These securities also hold U.S. Treasuries to serve as collateral for swaps and futures. Thus, many leveraged securities, including inverse securities, also pay a dividend. Most leveraged funds are exchange-traded funds, but some are exchange-traded notes, a type of debt security. The leverage objective applies only over a single day, before fees and expenses. Over time, leveraged securities will not accurately track the underlying securities and may deviate both in direction and magnitude from the underlying. Leveraged securities usually have higher fees than plain vanilla ETFs, but fees don't matter as much if trades are short-term. Securities based on the same index or underlying securities may deviate from each other because of how they are managed, especially with respect to turnover and fees incurred in their management. However, leveraged funds have greater risks than plain vanilla ETFs. It is possible to lose your entire investment. For instance, if the underlying securities of a triple leveraged fund drop 33% in a single day at any time during the day, then you may lose your entire investment, even if the security fully recovers by the end of the day. The best way to find leveraged securities is to go to the websites of the major issuers, or to websites that track exchange-traded funds and other securities. You should go to the websites of the issuers to learn any details of the funds, since they would know the funds better than anyone else. The issuers also provide the prospectuses for their securities, which you should read. There are many different types of leveraged ETFs. Many of these funds focus on the technology, but there are also leveraged funds for semiconductors, biotech, small caps, energy, regional banks, and even for gold miners. Although the issuers of triple leveraged funds often warn that their securities are only for day trading, simply looking at past performance shows that, in many cases, but certainly not in all cases, triple leveraged funds can do much better than their unleveraged counterparts. Here you can see the performance between a leveraged and unleveraged fund covering the NASDAQ 100 index. Even though the ProShares fund is triply leveraged, it did only slightly better than the unleveraged Invesco fund over 5 years. This chart illustrates the risk of leveraged funds. As you can see, the ProShares fund dropped more steeply after November 2021, eventually dropping below the Invesco fund. This clearly shows the compounding effect of leveraged funds over an extended time. Over 1 year, the Invesco fund did much better. This is because the ProShares fund declined much more than the unleveraged Invesco fund when the stock market declined dramatically in 2022. From the beginning of 2023 to about the second week of May, the ProShares fund did slightly better than triple the Invesco fund, and you can see that the increase is substantial, more than 71%. This comparison shows the difference over 6 months and over 1 month. So a triply leveraged fund usually does a lot better than an unleveraged fund, covering the same securities, but the performance differential changes over time, depending on the volatility of the underlying securities or index. With any leveraged fund, you should look over the information provided by the issuer to learn basic information and how it achieves its investment objectives. The issuer will have information on which sectors are covered and their percentages, the amount and timing of the distributions, and the securities held by the issuer. This is the information provided by ProShares, a major issuer of leveraged funds. ProShares' main leveraged product is the UltraPro fund, which has the highest market cap of leveraged funds. Leverage is primarily achieved using futures and swaps. Counterparties to the swaps are major banks, such as JP Morgan and Goldman Sachs. In this section, I want to show the performance of two other leveraged funds compared to ProShares, also based on technology, but the composition of each of these securities differs. Even though all three securities are based on technology stocks, their performance can vary widely over varying durations. The Direxion security is based on the Technology Select Sector Index. Exchange-traded notes or ETNs can also do very well, but they also carry additional risks. I picked the MicroSectors FANG Plus Index, 3 times leveraged ETN for this comparison. This ETN is issued by the Bank of Montreal, which is a major issuer of ETNs. The bank, according to their website, claims to be the 8th largest bank in North America. The bank's ETN is based on the FANG Plus Index, consisting of the top 10 technology stocks, equally weighted. You can see this index gains much more than even the NASDAQ 100 index. This is probably because NVIDIA composes 10% of the index, which is a very hot stock right now, because its semiconductor chips are a major structural component for artificial intelligence. Year to date, the Montreal security has done best among the three, even over 1 year. Note that the Montreal security returned more than 24%, while the ProShares dropped more than 6%. So, it can pay to diversify with different securities, even if they cover the same sector. Over 5 years, the Direxion Daily did best of all, almost doubling the performance of the NASDAQ 100 index. The Bank of Montreal issues many exchange-traded notes. The primary thing to note is that they are debt securities, so their prices will depend at least partly on the creditworthiness of the issuer. Note the maturity dates on each of these securities, all issued by the Bank of Montreal. Therefore, it is possible to lose your entire investment if the issuer goes bankrupt. But even if the issuer does not go bankrupt, if its credit rating declines, then the price of its securities will also decline, just like bonds. Inverse securities move opposite of their underlying securities. ProShares UltraPro Short has the highest market cap among inverse securities. It is designed to return 3 times the inverse movement of the NASDAQ 100 index. Amazingly, many inverse securities even pay dividends. You can see from the holdings that the inverse performance is achieved primarily with swaps, with major banks as the counterparties. However, inverse securities are extremely risky. Stock markets trend upward over time, so inverse securities will lose most of the time. Inverse securities are best to use when the index on which the security is based is at its peak or near its peak. In most cases, it would not be wise to hold it for more than a few weeks. Always set realistic limit orders to sell, good till canceled, right after buying an inverse security. The reason for this is to increase your probability of selling if, for some reason, such as being in an auto accident, you cannot access your brokerage account. As time goes on, if the limit price seems too high or too low, you can always adjust it. Year to date, the UltraPro Short has declined almost 50%. Over 1 year, it has declined more than 52%. Over 5 years, it has declined more than 98%. Since inception, it has declined 99.99%. Since the stock market trends upward, holding on to an inverse security for a long time guarantees major losses. To limit risk, always use only a small portion of your funds for inverse securities, and always use limit order ladders to both buy and sell. In case you were wondering if the UltraPro Short was ever almost $500,000 per share, the answer is no. Inverse securities do periodic reverse splits to keep the price within a reasonable range, but it does show you what happens to these securities over time. Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Check out my website at thismatter.com for more than 850 in-depth fundamental tutorials in personal finance, investments, and economics. Check out my books on money at williamspalding.com. Thank you.